Hello everyone, and welcome to Navigating Nexus, How to Master Sales Tax Compliance in the US. My name is Courtney. I'll be your host for today's webinar. Over the course of the next hour, we are going to be doing a deep dive into Nexus, what it is, who it applies to, and why you need to care about it. Before we dive into the meat of the presentation though, just a couple of housekeeping items for us to review first. First of all, a disclaimer to get out of the way, just a friendly reminder that here at Avalara, we cannot provide legal tax advice. We are not tax advisors. So everything that we do discuss today is for educational, informational purposes only. But as always, we will do our best to answer any questions that you may have to the best of our ability. And then I also just put up on your screen our safe harbor policy. So please take a moment to review this while I continue on with some additional housekeeping items. So as many of you know, if you've recorded webinars in the past, we are recording today's event. So if you'd like to listen to it again, or even share it with a colleague, you will receive a link to the recording within the next 24 hours. And that link will take you right back here to this console that we're all looking at. And speaking of console, let's review some of the windows that you're seeing on there. So first and foremost, and some of you have already been using it, which I love to see, there is a Q&A box on the left-hand side of your console that you can use to interact with us today. We will be responding to questions individually as we're able to through that box. And then we also have some time set aside at the end of the presentation with our speakers. So stick around for that live Q&A if you can. And if you're interested in getting more individualized answers to your questions, there is a box on the console where you could actually schedule a time to speak with one of Avalara's tax automation specialists. Like I said, we are not tax advisors, but they can give you more individualized information about your specific tax obligations and whether a solution for automation might be the right fit for you. And then we also have some related resources and links on the console if you're interested in learning more about Nexus or the topics that we're discussing today. That's also where you can download your own copy of the slide deck if you'd like to save them for later or just use them to follow along today. And then finally, I see some of you are also already using it, but down at the bottom of the console, you'll see a smiley face, and that's where you can add reactions. So let us know what you're thinking as we go throughout the information today. And for those looking to receive CPE credit today, we are offering 1 hour of CPE credit. We do ask that you respond to 3 out of 4 poll questions that will show up on your screen or on the console over the next hour. And then you'll also need to view the presentation for at least 50 minutes. So keep that in mind. Once you've met all of those CPE requirements, your certificate will be available in the download or earn certification box that's underneath the related resource. You can click on the icon to access your certificate, and you'll also receive access to it again in the email that will go out with the recording. All right, so let's meet our presenters. Today we are joined by not one, but 2 of my fellow Avalarians. So first up, we have Stephen Cabrera, who is a tax director at Avalara. He spends countless hours on the phone speaking with businesses just like yours today. Stephen, do you want to take a minute and say hi and introduce yourself?
Sure. So again, my name's Stephen Cabrera. I am a CPA and former California sales tax auditor. I've been doing this for more years than I care to admit, going on my 29th year. So been dealing with a lot, and I enjoy hearing different scenarios and consulting in as you can see, there's different areas. Now here at Avalara, I'm focused just mainly on Nexus and voluntary disclosures, which is what we will be talking about today.
Yep. Well, thanks, Stephen, for being here. And next up, we have John Chiswell. He's actually joining us from over the pond in the UK. He is a cross-border solution manager in EMEA here at Avalara. John, you want to take a minute and say hello?
Yeah, thanks, Courtney. Really pleased to be here. It's great to be with everyone. As the name implies, I'm a cross-border solutions manager, helping customers with getting their products to their customers when crossing borders. So helping out with things like duty and tax calculation, also item classification, so assigning the correct HS codes to products. Years of logistics background, so logistics focused, and I like helping our customers with that problems of getting their products to their customers.
Awesome. Well, between the 2 of you, we are going to be covering everything that people online today need to know about Nexus. So before I pass it over, I wanted to go over just a quick glance at what we're going to be covering today. So first off, we'll start with what is Nexus. Then we'll take a look at who Nexus applies to. This is especially relevant if you're located outside the US. How to know if you have Nexus and determining how much you owe, what you need to do after you trigger Nexus, so what that process looks like. And then we'll finally leave you with how Avalara can help, a look at some of our products and solutions that can help simplify it. And then, like I said, we do have time for Q&A at the end. And finally, one last thing from me, but there is a CPE or a poll question that should be appearing on your screen now. This is the only one that's going to be appearing in the slide notes, but we wanted to take a minute and kind of get a pulse check on what's the most challenging aspect when it comes to dealing with economic nexus for your business. And we have a couple of options there: knowing the activities that can trigger nexus, understanding the variety of nexus thresholds by state, identifying the types of sales included in those nexus thresholds, or determining where you have obligations, or what to do after you've triggered nexus. So we'll leave this up for just a couple more seconds. We're going to try to move through it pretty quickly so we can start getting into the meat of the presentation, what you all really care about. All right, about 5 more seconds. All right, let's move forward and take a look. So this is really interesting. Usually when we ask poll questions, one of the most challenging aspects is economic nexus in general, but now we're taking it a step further and looking about what are the aspects of economic nexus that are hard. So it looks like we have a pretty close tie between understanding the different nexus thresholds by state and understanding or identifying the types of sales transactions that are actually included in the nexus thresholds. What to do after you've triggered Nexus seems to be the least. So thanks everyone for responding to this. This gives us a good idea of what we need to be focusing on. And with that, I am going to pass this into our first section, what is Nexus? And I'm going to pass the mic over to Stephen.
So a lot of emphasis has been placed on economic nexus. John's going to go quite a bit over more detail about this. So what we've been seeing, at least what I've been seeing in the years, is that physical nexus has been around for many, many years. And Quill was a case that was decided in 1992, which defined many of the standards that we see today. And so historically, that's physical nexus. Be very, very aware that that nexus goes beyond economic nexus. Economic nexus became, after the Supreme Court decided in Wayfair, then economic nexus kicked off. So one of the things I want to impress upon you that's very important is that it only takes one trigger. You see a lot of triggers here, and then there's the triggers there. You only need one to create nexus. I'll turn it over to John.
Thanks, Stephen. So yeah, I just wanted to take a minute because obviously Nexus basically describes the contact you have with a given state and establishes whether state can then obligate your company to collect sales taxes. We're going to look into them in more detail further in the presentation, but just for now, just sort of scratching the surface, we'll go through some of the basics. So physical nexus, as the name implies, means a physical presence in the state. That can be either a staff, and mortar store, or even an office. It can also be something more nuanced, such as attending trade shows, anything where you're actually generating business activity from there. One of the ones which normally catches out customers I speak to in EMEA is something like holding inventory in a third-party logistics location, such as a warehouse. A big one for us is holding stock in Amazon using the FBA facility. So often people think that they're giving their stock to Amazon and the marketplace taking care of that, but actually by holding that stock in those Amazon locations, that's triggering that physical nexus obligation. And then obviously the next one, economic nexus, that's based on your business activity within that state. And there are thresholds for each state, and that's something which Stephen is going to delve a little deeper into shortly. For now, I'll pass over to Stephen again. We'll look at the South Dakota versus Wayfair ruling, which was a big change.
So I always call this is the doors were blown wide open with Nexus. And so I've been doing this a long time. It was a simpler world back then where you had, if you did this, you know, physically this and that, as John was mentioned, and then the affiliate Nexus, very more basic concepts. When economic Nexus was decided in June of 2018 with the Supreme Court, when it was Wayfair versus South Dakota, the world of economic has changed where they added another layer. So I wanted to emphasize there's a whole list of triggers that John just mentioned. Think of economic nexus as another trigger. You only need one. And what happened is that now out-of-state sellers, if they went over the threshold, and we're going to go over those thresholds, create economic nexus. And one of the reasons why I suspect they did, and I've read some articles, is that for many, many years, companies were legitimately able to avoid physical nexus in some ways because they weren't doing any of those things that we had highlighted on the blue slides and some of the things affiliate nexus. And they were only collecting sales tax in their own states or maybe a couple of states. So when a product is subject to tax, tax is due, but sellers were not required to collect the tax. Buyers are supposed to be paying a use tax, what it is, it switches to the buyer, and they're not paying the tax. So millions of dollars of tax revenues were being lost by the states. So when this came on board in 2018, different states adopted it in different years. So a few were in 2018, some in 2019, 2020, and eventually all 46 taxing jurisdictions have adopted South Dakota. Missouri was the last one in January of 2023. So this is what was asking on the poll. People were asking, understanding the thresholds, understanding the types of sales. Very, very important. So this map illustrates the different thresholds. This is a key. You know, by color, the thresholds. As you can see, there's a lot of variety. And that's what made it pretty painful in the beginning to get a hold of, get at your grasp. And we have it for grasp today. But even when we call the states, believe it or not, we said we need some clarification because your website or the information in the law is not clear. The agent said, well, we think, or we're pretty sure, we need to get back to you. I mean, they didn't even know the answer. So there was a lot of, you know, legislation, controversy as this was emerging. The dust finally settled over the years, and we have our thresholds. Some of the states actually changed their thresholds over the years, but it's pretty much, for what I've been seeing, they're set. So let's go over some examples. The state of Connecticut, they have a threshold which is a little bit unique. In most states, right here, it's either you meet $100,000 or 200 transactions. This is a unique state, is that you have to meet both. Might be a little more difficult to reach that, maybe, depending on your business model, to meet both of the conditions. In New York, I'd like to mention that it's based on gross sales, meaning everything. New York's threshold is 500,000 and 100 transactions, but New York only includes the sales of tangible personal property and software as a service. Then we get to states that start picking apart the types of sales. So to illustrate, you know, I gave you two examples. For, as I mentioned, New York is tangible personal property and SaaS. California, the threshold is one at the highest, $500,000. But California only includes the sales of hard goods. So when I refer to tangible personal property, I'm talking about hard goods. But in that state, it's exempt and taxable. So, and that's all. That's all California assesses for economic nexus in a calendar year, 500,000. Florida, they're different. Florida also only counts hard goods, tangible personal property, but they limit it to just taxable goods. And they're on $100,000, no quantity count. So one of the biggest things I want to impress upon you is that it's a wide range. You can create Nexus as low as $201, and I'll explain why. There's a number of states that you see here that it's $100,000 or 200 transactions. Those 200 transactions do not need to add up to 100,000. They could be as low as $1. So most companies, probably don't sell things for $1 unless it's a certain business model. It's e-commerce and they have a lot of high volume, low dollars. But the point is, if you were to have something as low as $1, once you have 201 transactions, you have created Nexus. So it's very important that you understand the types of sales, the thresholds, understanding your business model. And when you take a look at this, I highly encourage that you all download this, because we've tried to put this in a more easy to understand model, because you did answer, most of you, as far as the thresholds and the types of sales. So we've tried to put this on the Avalara website. We have a lot of great articles. We have information like this. So I highly encourage, get familiar with it, because often I hear customers saying, well, my sales are $100,000. And they're thinking in terms of just gross sales. And that could lead to a couple of different problems. One, do they sell tangible personal property in Florida? Well, they don't have Nexus. Doesn't matter if they've gone over $100,000. So there's different misconceptions I'm seeing. Get familiar with what you're seeing here, and you should be in much better shape.
Perfect. Well, we have another poll question that's appearing on your slides. This one is just going to be in a pop-up window on your window, so we're not going to take a minute, or we're not going to respond to the how you guys answer, but it will stay up on your screen. Stephen, quick question for you before we move on to the next question. I see you kind of mentioned this, but for every state, is it a calendar year where those Nexus thresholds kind of reset, or how does that work?
Oh, that's another variation spin on that. So most of the states are on a calendar year basis. Texas is on a rolling 12 months. So every month you got to look backwards the last 12 months and see, did I go over the threshold? Some states have some sort of fiscal type period. There's a few. Now, New York, they don't go on calendar quarter. They're off by 1 month. So you could have November through January, and every quarter, based on that, you add up your 4 quarters, but it's not on those calendar quarters. So yes, there are different variations. Very important you pay attention to those variations.
Perfect. Thanks for going over that. All right, so John, we'll pass the mic back over to you. Let's talk a little bit about who Nexus applies to. Who needs to pay attention to these things?
Yeah, thanks, Courtney. So as Stephen mentioned, since the ruling in 2018 and the change for the introduction of the economic nexus, the Nexus rules now apply to businesses located outside of the US. Again, being from the UK, putting my EMEA hat on, the businesses that I deal with normally located in EMEA feel that they potentially wouldn't be bound by the US sales tax rules, and also that potentially the taxation in the US is relatively similar to VAT, which is completely not true. It's vastly different to VAT. Unlike VAT, which is charged at every stage of production, so you have an item being produced, it goes through the manufacturing process, it's moved to the transport, it's actually sent to the business and then on to the consumer. At each stage of that journey, VAT is added. And the consumer, the final person that's purchasing the product, pays the total combined for that value-added tax. Whereas in the US, the tax is paid by the end consumer at the final point of sale. So for this reason, many transactions in the US can be exempt from sales tax, but something that often catches customers out, whether it be in the US or customers from EMEA, is that these exempt transactions can still count towards those Nexus thresholds. Again, European customers often say that I'm providing services or goods which are exempt, or I'm providing these to an exempt business. Therefore, I have no Nexus. I don't need to worry about that. But some of the thresholds in the US, those exempt transactions count towards that, it does create that requirement, and it's something that companies need to be aware of. The other key thing is that, again, in Europe, each country is a taxing jurisdiction. So the VAT rate are country specific. You just have the standard rate, a reduced rate, and then potentially a zero rate. So it's quite, I don't want to say simple, but it's easier in difference to the US to actually work out what your product would be in terms of that taxation. In the US, there's more than 13,000 different taxing jurisdictions. It goes down to county and city level. And the taxes can change down to a street level, with neighboring properties having a different rate of sales tax, which can make it really, really difficult for businesses to accurately calculate the correct level of tax and to charge the customer accurately. And the final thing, obviously, something which we don't have in EMEA is the US sales tax, which is a real different piece for us to get our heads around as well. So, how do you if you have Nexus? So we looked at before, obviously, what is Nexus? That is, they would move into some of the different types of Nexus, and we have listed here on the screen 4 different types. So we have affiliate Nexus, click-through, and then we've got the economic and physical, which we've talked about. So affiliate Nexus laws have been around since around 2008, and under affiliate Nexus laws, an out-of-state business establishes a physical connection through in-state affiliates, employees, or representatives or other entities. For there to be affiliate Nexus, there needs to be a relationship between the entities, but the nature of the relationship varies a great deal from state to state. Click-through Nexus is basically your out-of-state business can establish a connection to a state through an agreement to reward a person for directly or indirectly referring potential buyers through links on a website. So you think about your business activity, if you have those non-directly employed people that are actually influencing your product and they're influencing customers to go through and purchase your product, that's going to potentially create Nexus. And then the other two, obviously, we've been through those. The economic Nexus, which has been outlined by Stephen earlier, it based purely on the thresholds and it's based on your business activity, with the more common being $100,000 in sales or 200 transactions. And then physical Nexus, as we looked at earlier, is triggered by employees in the state, physical locations, holding stock, or again, even attending those trade shows. But there are a number of ways which a business can actually generate Nexus in a state. And for all the people on the call, you will also know your business activity, your business model. There will probably be one of those which is more relevant to yourselves, but it's good to know each of them because you can be caught out by not understanding if there is a different type of Nexus rule which could relate to your business.
I'd like to add one more thing. So, John, thank you for keeping it simple on click-throughs. It's well defined. I hope I'm not going to complicate things. Wanted to add an example of click-through. So let's say I'm a business in California, and I have a relationship with another company who has a website in New York. They're based out of New York. Their website, let's say that they're in the sporting industry, and they sell mainly apparel. I sell kayaks and different things that could be related. And I say, hey, can I put my icon on your website? And so within New York, those sales are trying to build the New York market. Well, if somebody goes they click through, what that will do is create Nexus. And so often the web owner will be paid by my company to have a icon in that state, and then they have to pay a nickel per click, or there's some sort of set. So if that derives an X dollar amount of sales, then that's going to be varying by state, and not all states have click-through. Many states do, but that's just an example of the advent where click-through Nexus between two states can create it when you have a business relationship like the affiliate Nexus, kind of a variation. So you can get more information. A lot of these, we're trying to keep this high level, but that's kind of an example of click-through. Okay, so as I was saying before, with the advent of economic nexus, it caught a lot of sellers off guard. And you start off with an example. Let's say that you're making sales into 10 states. You're in one state, you're selling into 10, you only have nexus in 2. And let's say that you only have economic nexus and you have some high sales in these states. But over time, as many businesses do, they want to grow their sales. Year over year, they may have goals. And they're successful, let's say. And as they grow, you know, it was 2 states. Now, let's say a 3rd state, they have exceeded the threshold. And then in that same year or the year after, they have sales that went over again in that state. Well, that could, you have to look at it holistically. That don't just look at year 1 and say, hey, took care of it. Be mindful, and a lot of you probably are, but sales tax, I often feel, takes a back seat. You know, companies are focused on income tax, payroll tax, workers' compensation, and a lot of these regulatory. And sometimes when sales tax takes a back seat and you're not watching your thresholds, those states can add up over time from a couple of states to multiple states. So the basic thing is, once you trigger Nexus, the best place to be is as you're approaching a threshold and you think, hey, we're doing great, we're probably going to go over. My recommendation is, let's say about 80% there, and you really know that you're gonna go over. Just get registered now, because if you wait until you cross, now you're allowed to actually register in a state without Nexus or before hitting Nexus. The states love it because now the tax dollars are rolling in. But what the point I'm trying to make here is that before you trigger Nexus, slightly before, or indefinitely when you hit Nexus, get registered, because if you're not watching your thresholds, then what could happen is that grace periods will expire, time is going on, and sales tax is still due to the state, even if you don't collect the tax. Somebody's got to pay that tax, as I said before. So this point here is merely, reiterate that there's a timing involved. My suggestion again is really to be mindful, get registered, just do it. So that way you're not, concerned about missing the crossing date. So we mentioned grace periods by state. What that means is some states have so many days or so many months. In some states, let's say you cross the threshold November 18th of 2023 in a particular state. Of course, this all varies by state. So a certain state could say, well, you cross it November 18th, then you have to be registered by the first day of the following first month that follows. That would be December 1st, that following month. Some states will give you 2 months, 3 months. Some states are generous where they'll say you have a grace period and you don't need to get registered until January 1st of the following calendar year. So there are variations, of course, with economic nexus. We already talked a little bit about this, the 13,000 jurisdictions. John had mentioned that, so I won't go into a whole lot of deal. But over the 46 taxing jurisdictions in the U.S., each state has, as John mentioned, think of sales tax as a pie. And it's 8%, let's say. It's going to vary by city. And so you have 8%. The state wants 6% of that. The city gets 1% of it, let's say, in that particular. I'm totally making this up because it's going to vary. The county wants 0.5%. Let's just say another 0.5%. So you've got 7.5%. And then let's say there's another 0.5% in this local jurisdiction where it's a special tax. So you've got these multiple jurisdictions, and by the time you add up all the allocations of tax and how it gets allocated out, it's been estimated about 13,000. So if you sell, obviously the more states that you sell into with Nexus and reporting requirements, you need to be mindful that those monies get allocated properly. Sales tax returns, when they're filled out properly, then it's designed for you to provide your, follow the directions, and then typically those are going to be flowing into the various jurisdictions. I'll turn it over to John.
Yeah, thanks, Stephen. So automation and technology. It is, as the slide you can see there says, it's no longer a luxury and a requirement. And the key thing there, I think, is to help businesses comply at scale. One of the most common things we see when we're speaking to customers is that they've been trying to manage this in-house. And they're trying to manage the many different jurisdictions with multiple employees. So they put manpower towards it. As the business grows, obviously you need to increase that manpower, and that's increasing cost and burden to the business. Automation really is something that you need if you're looking to expand. You're looking to expand in a cost-effective way. Without the automation, you're going to find that your staff will be buried in these tasks, which could potentially be offloaded. And each hour that they're spending on tax management is an hour that's going to be lost on more important parts of your business. And you could also potentially be taking on unnecessary risk. With up-to-date rates and rules, which can be maintained by a cloud-based tax engine, automated tax software can increase the accuracy of your tax compliance. And with automation, the calculations are more accurate, the use tax can be assessed, and the returns can be filed on time, as well as your exemption certificates being up to date and easily accessible. You can also make sure that you're registered in all of the right locations as and when you need to. Again, something we often come across, and Steve has mentioned with regards to the historical aspects, so making sure that you're up to date with your companies come to us and they've been trading in the US for quite a while and they've exceeded threshold previously and they need to expand on that. It's important to keep up to date and make sure that you're registering as when needed. Automation can also decrease the tax complexity that can come with business growth. So the effort that's required to maintain that compliance in a few states is dramatically different when you do business in most of the US. And then if you add in selling in different countries, you've got a whole new level of complexity. With automation, it's much easier for you to just scale the business as needed. You can plug in new locations, new countries, as and when they arrive. Shameless plug, but automated tax solutions like Avalara can integrate into the most widely used solutions, or you can use an API, which can allow you to manage your tax compliance within a single dashboard. I will pass back. Oh, no, sorry, it's me to continue. That's right. So we're going to talk about determining how much of a financial risk has been triggered. There we go. So I think as Courtney outlined at the beginning of the call, I'm not a tax advisor, so it's not something that, I'm giving you tax advice here, but this particular piece is, we would probably say more in terms of common sense. You can look at your Nexus and examine how much your financial risk would be. So as the slide shows you here, do you have a $5,000 a day problem, or do you have a $100 a year problem? And obviously, your reaction there you can measure by the amount you owe. If you've got a very small owing, probably don't need to do much. Again, not a tax advisor, so don't take it for gospel, but if you've only got a small amount, there's a very, very minimal exposure or risk. You probably don't need to do much in terms of taking action, but it's something to be aware of. Whereas if you have a $5,000 a day problem, you've got lots of sales, lots of taxes being collected, and you need to pay that back, that's something that you definitely need to react on because you could be audited at any time. I don't know how the states work that well, but I don't suppose they give you too much in terms of notification and information to say that you are going to be audited. They can occur quite quickly and unexpectedly. And these can be very, very time consuming. and damaging to a business's activity levels. It can also mean that you're going to incur additional fees in the form of penalties and interest. Penalties and interest, excuse me. And then depending on how much you potentially owe, there is a solution which you could look at, such as taking advantage of a voluntary disclosure. I'm not going to talk too much on that because that is pretty much Stephen's expertise, I would say. He deals with that very often, and I know we're going to be talking about that shortly. So I'll pass that back to Stephen, and we can actually look at some of the differences there.
Thanks, John. It all begins, of course, with Nexus. That's what I say. If you don't have Nexus, it goes out the window. But when you do create Nexus, we did mention earlier, time to get registered. One of the things that you have to be careful about is when you go before government and you start filling out those applications, many of them are designed to conduct a Nexus survey. Questions like, do you send people into the state? Do you have warehouses? Yes or no? How much of your sales have been over the years? Now, when you answer yes, and of course, I'm always encouraging truthfulness, these government applications are under penalty of perjury. So when they ask you, do you have representation? Now, one of the things we want to reiterate is that if you have in-state representation, I use that very broadly. And so you could have an employee go into the state, you could have an independent contractor. So the state laws provide mainly, they're saying, are you sending somebody into the state? Often the misconception is, well, I don't have any employees that go into the state. So I always ask, okay, do you use any outside individuals as 1099, whether it's selling, installing? I usually use a rule of thumb that if you send somebody into the state to do something on your behalf, you're going to trigger physical nexus, generally speaking. And so you have to be mindful, because often the misconception is, well, they don't do sales, they do training. Well, that counts in many states, training. So be mindful that when you are filling out your applications, the government is going to be surveying. And when one of the biggest things is, let's say that you fill it out, a big question, I call it the $1 million question, is the state's going to say, if so, when? And so you put down approximately March of 2020, and you have representation. Well, the state's automatically going to know that you've had Nexus for 3 years. And they're going to expect, and what they often do, will retroactively date your application start date to March of 2021, or whatever the date was in the past. What that means is you would have delinquent tax returns to file. Now, if you have 100% exempt sales, and they truly are exempt sales, not really a big deal, because now I don't want to discourage anyone from following the law. Some states may require you to file a whole bunch of zero tax returns. But generally speaking, when you don't have tax, there's no penalty, generally speaking, because penalties are usually on the unpaid tax. So there's no tax due. Interest is statutory on the unpaid tax again. But often what I find in practice is that most companies are making taxable sales. Remember what I said before, is even if you don't collect the tax, somebody's got to pay that tax. And if you have Nexus in the past, so I'm giving a worst case scenario that once you fill out these applications, if you weren't timely in getting registered, that's where the states are very savvy. They're trying to pull, survey, and read those applications to determine, do you have historical Nexus? Now, when you take a timely application, you found out you just created Nexus a week ago. Well, it's even a month ago. And you right away, you're in your grace period and you fill those out. And you did just send somebody in barely within the last week, in the last month, or whatever it was, holding the inventory in the state and all those other Nexus. If that did barely happen within a month because you were timely, well, then the state's going to see that's fine, right? You barely created Nexus. You can register and file forward. When you have historical Nexus and you have liabilities, you cannot simply register and file forward. What we're showing here under the unresolved delinquencies means that if you have a delinquency, the states expect disclosure. They expect the filing of those tax returns for those historical periods. We mentioned voluntary disclosure again because we want to reiterate that that's a solution. We've been talking a lot about how do you create Nexus and what happens when you create Nexus in historical liability periods. So we will be covering shortly what to do as far as a solution. Right now, we're going over adding new states. Now, this is a basic concept. We kind of talked about this before, that as you create Nexus in additional states, you're getting registered, you need it to set up your processes. John talked a little bit about this with processes. You have to be cognizant of all these jurisdictions, depending on how many returns, and getting those allocated using automation is best case, because it can be time consuming. The more tax returns you have to file, and you want to be accurate, because in the event of audit, one of the things the auditor, like what I used to do, is I would look for mistakes. I would look for either overpayments or underpayments, or if it was close enough, reasonably, I would write them up as a comment, don't do it again. But it was my job that I would have to. I have to assess tax if the tax returns were not prepared properly or timely. So what we're talking about here is preparation. You need to have processes, internal controls. If you're doing this manually, you have to, for example, you collected $8,000 last month. Time to file your tax returns. And you're filling them out, and the formula came out to $6,000, and you pay the $6,000. Well, you can't keep that other $2,000. There has to be an internal control. Auditors, what they do is a reconciliation. So when you're preparing and filing your tax returns, you have to look at how much tax you collected and how much you're reporting in the tax. They have to equal. You also have to look at, as a secondary check, is how much in taxable sales did I make? Let's say you actually made $50,000 of taxable sales last month. You're doing your counting, and somehow you came up with 40,000. Maybe it's legitimate, maybe at discounts, but let's say you don't have discounts. That 40,000 makes it to the return, regardless of what the tax collected. That could lead to more problems. It's underreporting. By the same token, you might be over collecting tax. So when you're preparing your returns, have some sort of reconciliation in place. If you're not using automation, often automation, as they've been developing over the years, they have built-in internal controls, because the basic concept for Avalara and other cloud-based is they're taking the transactions through an API connectors. They're pulling the actual transactions if it's set up properly, and they're always experts to set that up. Then the tax is extracted out of accounting systems. The tax engine with Avalara is calculating the right tax. It's going into your account. The logic is designed to pull and prepare those tax returns. If an audit were ever to arise, a good reputable tax advisor like Avalara, we have features in the software that you can provide limited access to the auditor. If you don't want to do that, the auditor asks you for something. The way your tax returns are prepared in AvaTax, you can run reports to provide to the auditor to satisfy what their objectives are.
All right, it's time for our third poll question. So again, this isn't going to show up in the slide section, but you should see it in a pop-up window on your screen. So let us know, how automated are your tax processes and technologies? And that'll stay up for a couple of minutes while we keep moving forward. Lots and lots and lots of great questions. So we'll get through as many as we can. But for now, I'm going to pass it back over to Stephen to talk a little bit more about how Avalara can help with all of this.
Okay, we'll be mindful of time, so pardon me if I talk a little bit fast. So we've been talking about how you create Nexus. Really, the basics are knowing this is the basics of multi-state sales and use tax compliance. Know where you created Nexus. When did you create Nexus? Determine how much do you owe, if you do, if you have taxable sales. and then solutions. So that's called a Nexus study often. And so Avalara has a free Nexus tool. There is a link embedded here where you can click on it. It'll take you to our website, have your sales ready. It's really only focused mainly on economic Nexus. So you'll be prompted for questions. Remember what we went through. Those questions are going to be very specific to how much you sold, quantities in certain states, the type of sales. That's where a lot of people I've seen do it incorrectly. They just put gross sales. So pay close attention to what the state is asking as far as the type of threshold. What that will do, it'll provide you a limited result as maybe if you want to just get a high level and you do it correctly, results will tell you where you have Nexus. Now that tool it's a good tool, but it's only going to tell you that you've had Nexus recently. You're not doing a test for the last 4 or 5 years. And if your company's been around for 3, 4 and longer, you may have created Nexus in prior years. So this is a good start with the free Nexus tool. But for those of you who want a more in-depth analysis, we do offer a premium sales tax risk assessment. That is, as we say, comprehensive. That means we're going to review the entire, this is what my department does. And what we do, this is exactly, when I was at Deloitte, we would do the same thing. I was pleasantly pleased to see that Avalara has the same robust due diligence. And so it's important that you put together the data. What's done is a survey is given to you. Examine your business model. Those questions are designed just like a sales tax audit the government would do. And when you do things like government would do, it's going to manage your expectations. We're going to catch things that government would catch. We're going to prove not only where you have Nexus, but where you don't have Nexus. That's important to know because you can breathe easy at this point, set those states aside, focus on the states. And so what we do is determine where you have Nexus. When did you create Nexus? How much do you owe the state? These are calculations run through AvaTax, through a team of people, expertise. Myself and 2 other tax directors, we will review. We're CPAs. We review the work to ensure that these are correct and presented to you. Now that we know the liabilities, if those arise out of the risk assessment, time to decide what to do. So there's, as I said before, knowing if you have Nexus, when, liabilities. Now it's time to make some decisions. And so what we do as well is one of the services we offer is voluntary disclosure. This is your solution because we've been talking about all these concepts of Nexus and you're thinking, okay, fine, now what? You know, if I get Nexus and I have a liability, what are some options? So one of the options is voluntary disclosure. This is an offering by the state. And what they're saying is it will include your registration. All the delinquent tax returns will be filed for the period. Penalties will be waived. I always want to impress upon my customers that when penalties are waived in this program, it's non-negotiable. That sounds bad, but it's actually a great thing. In most tax situations, generally speaking, you have to petition the state. You have to ask the state. You have to tell them why this happened and ask them for that they be waived. In the voluntary disclosure, it's an incentive. So think of this like a tax amnesty. They're saying if you come forward and voluntary disclose your liability, and as long as you've never been contacted by the state, a couple other little nuances, but that's mainly as long as you didn't receive a notice, the state's asking you directly about your sales tax. And the voluntary disclosure, as I said, registrations, delinquent tax returns, penalties will be waived. These are agreements with the state. So when you go into voluntary disclosure, you know exactly what you're getting into. The liability periods, when we say shortened to 3 to 4 years, most states have a limited look back. What that means, if you owe 5, 6, 7 years of tax, most states are going to say, fine, we're going to limit your liability to 3 to 4 years, depending on the state. A couple of states go a little bit longer, but the point is, you're not only saving tax, interest, and penalties, those are going to go away for time that's beyond the 3, 4 years. But within those 3 to 4 years, you will get your penalty abated. So in consulting, what we try to do with you is look at the big picture, try to shrink it down, or we would shrink it down through voluntary disclosure. We provide full representation through power of attorney. We'll handle your registration for you. We'll handle the filing of the returns. All of this is really computed in the risk assessment. We know what you owe, We know what your penalties are. So when we bring this information to government on a state-by-state basis, maybe you only need one voluntary disclosure. Maybe you need 20 voluntary disclosures. You don't have to go through voluntary disclosures. There's some other options which we won't get into. It's more simplified registration and filing. Voluntary disclosure is really great if you have a long liability period, when your penalties are large, and that is a great solution. What we offer. Back to you, John.
Thanks, Stephen. So just looking at registering and collecting sales and use tax. So from an Avalara perspective, this is something that we do very, very common. It's a big part of our business. It can be very, very difficult without using a partner like Avalara, as every state has a different process, a different application, and process for sales tax registration. So you can fill out your form just once, and we would handle the preparation and filing of sales tax registration in the jurisdictions that you specify. We would also prepare the necessary application forms, make the payments directly to licensing authorities, and follow up with jurisdictions to ensure that everything is processed within normally 5 to 7 business days. The applications are sent directly to the appropriate jurisdictions or back to yourselves to complete any final steps. You will receive confirmation of the applications that we file for you. Again, from an EMEA perspective, this is something that is unusual for EMEA customers. Obviously, having a registration with each individual state. The normal process, obviously, with a VAT registration is that it covers just a single country, so it is quite unique from that perspective. But obviously, having a partner such as Avalara to assist you, it is a managed process or an outsourced solution, and we are effectively handling most of the legwork for you on that. So moving on to actually manage returns. The Avalara managed return solution provides sales tax preparation, filing, remittance, and notice management. And the managed returns also include state and local returns, filing in Canada, and other advanced capabilities. Prepare your returns and remit payments to the appropriate jurisdictions in just a few steps, and then you can issue a single payment that Avalara remits to each jurisdiction on your behalf. The managed returns solution also connects to many different e-commerce systems. I think we have over 1,300 different pre-built connectors. You can connect through that now. And also connects to major marketplace platforms as well. I think then we move on to our last poll question. I could be wrong, Courtney.
Nope, that's right. We have our last poll question showing up on the console now, but that is actually the last of the slides that we have. So we'll take the last few minutes to dive into Q&A. Just to give everyone context, we have had over 200 questions submitted. So obviously we are not going to be able to get all of them answered today, but we'll take a look at some of the themes and try to dive into them that way. There were quite a few questions that came in about attending trade shows. So is there a time frame on, or I guess, does it depend how long you attend a trade show if it triggers Nexus, or is that another one that depends on the state?
I would say it depends on the state. I'll give you 2 extreme examples. You show up at a Texas trade show, you put a badge on or a little sticky with your name on it if you want. You walk around, that creates Nexus. The Texas comptroller feels that you are there to conduct business. Usually these trade shows are for business reasons. You don't have to give a speech. You don't have to set up a booth. Just the fact that you're there. Now, California is much more generous. There is a time frame as 15 days $100,000 if you do that. You can show up, stay around at the trade show, set up a booth if you want, as long as if you're making taxable sales, open a temporary tax ID. The other states, some are saying it doesn't matter. You can come in, you can do attend trade shows, no problem. Other states are going to have a set of days. It's going to depend on the state.
Okay. All right. We've had another group of questions about remote employees. So I'm going to try to compile several of them into a single question. But if you have remote employees in a state, but no sales in that state where the employee is located, does that still count as physical nexus?
Yes.
Okay.
But there's two conditions where you have to file. You have to have a sale. So you can have nexus, but until you make a sale, generally speaking, then you have to get registered type filing, even if it's exempt sales. Also, I want to add, 1099 also count. So if you got a 1099 and they're waiting for the big day to make a sale, you've already got nexus, but you don't have a filing obligation until those two conditions are met.
Got it. Okay. Let's see. There are just so many questions to pick from here. It's hard to nail down just one. This was a good one. What constitutes a transaction? So with economic nexus specifically, it can come down to the number of transactions that you're doing. Is there continuity in the way that states define what a transaction is, or does that also depend on the state?
It's pretty standard. Generally speaking, it's standardized that a transaction is considered a sale. So you could sell 10 items in that one sale. It still counts as one sale.
Okay. And then I've also seen a couple of questions for people that have sell services and they have monthly subscribers. And so they were curious, does each month's kind of invoice or transaction count as a single transaction, or are they all lumped together because it's part of an annual subscription, so to speak?
They each count.
Okay, good to know. Let's see. How do you know which jurisdiction you need to register in if you're selling into a state that also has the local jurisdictions with economic nexus? Do you have any points or helpful things on that?
John, I don't want to answer all the questions, but I'll answer, and if you want to chime in. So with the exception of Alabama, Louisiana, and Colorado, they have special rules, which there's not enough time to get into. But generally, you register at the state level. Once you register at the state level, it will accommodate all those local taxing jurisdictions, generally speaking.
Thanks, Stephen. I was going to say my audio is probably not the best, so you're clearer. So answering questions, I think it might be better if you are. So I'm quite happy.
All right. Well, we have time for just a couple others. One person asked, is it more beneficial to just register in all the states they do business in just to be safe?
Depends. I mean, if you're not selling, there's 46 taxing jurisdictions. If you're only selling 10, no. If you really think your company is going to blast off and you're going to be hitting nexus, or you're sending people, best case scenario. Again, it's not just people, but let's say that you're going to expand your territories right away. You're going to cover 35 states, maybe even 40. You're already going to have nexus. And if you're going to start making sales, yes, it makes sense. But if you're a very small company and your sales are very small and you do have nexus, but you only have nexus in a few states, you could take the conservative position and say, I just don't want to worry about this. I'm going to get registered everywhere. Or you have to, the other ways, you're just going to monitor your nexus progress.
Yep. Okay. One final question. So what happens if a business triggers Nexus 1 year and then in the next calendar year for the next few years, they don't? They would have still had to register in the first year, but what happens in that scenario?
Well, obviously you need to get registered. Let's say the following year one, you hit Nexus, you get registered. Year two, you don't hit Nexus. You won't find that out until year three when you look back at year two. And you call the state and you say, I want to get deregistered because I didn't go over the threshold. Many states are going to say, well, you need to stay open 1 more year. Now, I always tell customers, that if you have Nexus, don't have Nexus, have Nexus, don't have Nexus, you're going to have to register, deregister. Even if the state says go ahead, that looks questionable to the state. That might trigger an audit. And it's a hassle to keep going back and forth with the state.
Yeah. All right. Well, I think we have gotten through all of the questions that we can in the allotted time. I'm going to go through just a few final reminders, but Stephen and John, first of all, thank you so much for being here and sharing your expertise. I even learn a lot. I've been here at Avalara for 5 years, and every time I do a webinar, I'm still learning more. So appreciate you both being here. As a couple of reminders for the folks who are still on, if you qualified for CPE, so you responded to 3 out of the 4 poll questions and you attended for at least 50 minutes, you can download your certificate in the Earn Certification box under the related resources. You should see an icon appearing there. And then we will also include a link to your certificate in the email that will go out as well. And then just a couple of final reminders about some of our upcoming webinars. So here at Avalara, we do several webinars a month to help you understand more about your tax compliance and what you need to know. So on March 19th, we have a webinar that's going to focus on tax research and how automated tax research can help you get your tax decisions right. And then on March 28th, we are diving back into 2024 tax changes with our Q2 Outlook webinar. So we'll detail what some of the recent updates are in tax policy that you need to know and what to keep an eye on for the rest of the year. So if you're interested in either one of those, go ahead and visit avalara.com/webinars, and you can see all of our upcoming and on-demand webinars available there. So again, everyone, appreciate you spending the last hour with us. Hopefully you found this information valuable. And Stephen or John, any last remarks from you before we close out?
Contact us. We're ready to help you.
Exactly.
Absolutely.
I second that.
Perfect. All right. And just a reminder, we will send out a link to the recording and you'll have access to this console again. So if you want to access any of those links, you'll have access to these again. So like Stephen mentioned and John mentioned, definitely check those out. Some of them are good to bookmark as well, so you can reference them in the future. So, all right, everyone, have a great day, and we'll see you for one of our future webinars very soon. Thanks, everyone.